Well, US 10-year yields hover at record lows. Questions also around what the RBI will do next, and lots of questions around the outlook on bond markets as well in the aftermath of the coronavirus scare and continuing scare, actually. Bhaskar, Panda also joining us this morning, as well as Dhawal, Dalal. Thanks for joining us, both of you. Bhaskar, let me start off with you then. US 10-year bond yields at a record low. So now what does this indicate, apart from the fact that, investors are choosing to flock towards safer asset classes?
See, if you look at US bond yields, it is at record low. But if you look at the way, for example, the future, what it looks like, it still is, looking forward to some more rate cuts. So even this 50 basis point surprise rate cut by Fed is not enough, looks like, from the market behavior as of now, because still the yield curves are inverted, as of now. How it will, come about is a little difficult to predict at this point of time, given that coronavirus, still is current. But I think, at least from my personal opinion, I don't think any rate cut is expected from US in the next in this calendar year, because after 2-3 months they will get into the presidential election mode, so they may not do anything around that point of time. So maybe there is a window of another 3 months within which they might look at the rate perspective, but after 50 basis points, I don't see them coming, with a hammer to cut the rate. So that's my view as of now.
Because you have a hammer does not mean every problem is a nail, and that's what central bankers are doing. Gold is slowing down, start slashing rates. Dhawal, good morning. Thank you for joining us. Okay, rates have been slashed, but low rates have not kick-started economies in the past. That is the evidence which we've got from Europe and Japan. So what do you think is going to happen to the world next?
So, see, from our perspective, I think whatever the Fed has done, I think from the historical perspective, Fed has cut rates in between the policy about 6 times. And every time the next rate movement has been on the lower side when the policy was due. So from this perspective, I think market participants are also expecting the Fed to reduce the Fed fund rate further when they meet again later this month. But from our perspective, I think we are viewing the entire episode in a 2 different way. The short-term impact of this is basically to address the supply-side concern becoming a demand-side concern, as can be seen through the car sales data or the footfall in malls and other anecdotal evidences. So in that to that extent, I think it is appropriate for the central banks to have an insurance against any further sharp decline in the demand side of the economy and impacting the economic growth further. But from a different perspective, we believe that, I think, to a certain extent, there is some realization among the policymaker that the world economy hasn't been in a great shape, particularly after the global financial crisis, and despite a significant amount of quantitative easing and liquidity injection that has been done. So to that extent, from the US perspective, some of the policy measures taken earlier in terms of dot plot charts and quantitative tightenings have resulted in a further increase in the fragility and the prospects of further recessions down the line. So from that perspective, I believe that the recent cut in the Fed fund rate and the coordinated talks of coordinated policy actions are perhaps aimed at addressing some of the mistakes, policy mistakes that central banks have done earlier, and to normalize and ensure that the confidence of the consumer comes back and the economic growth remains on track.
But Bhaskar, just looking at the way the India yields have been moving, is there any way in that they're already pricing a rate cut by the RBI? Because, a lot of people, like you also highlighted, have been talking about a possibility of an out-of-policy rate cut by the RBI.
See, the market is already pricing in a rate cut. The quantum of that is something which will come about as and when they take that action. But if you look at the bond yields or the market action post Fed rate cut and easing of other parameters including the oil prices, so on and so forth, if you look at the 10-year bond yields, that has majorly come down. Now, whether it will be 15 basis point, 25 basis point, 35 basis points, everybody is talking about it. Nobody is sure what will be the policy response. Whether it will come in between the policy also is something is being debated. I am not sure, but what I am more certain is that there is a rate cut expected, especially after the Fed's rate cut and RBI's rate cut. And as Dhawal said, there are talks about policy action from all the central banks in a coordinated manner. So if we take all these indications, then rate cut is possible and it is probably coming. But quantum of it is something which is debatable. Second thing, we need to remember that Indian inflation is going to be sticky and it is definitely remaining higher than the comfort zone that RBI had for last few years. But having said that, obviously growth is a worry across the world and growth is a definitely worry in India itself. So to balance all these things, probably we could see a rate cut coming.
Dhawal, for a bond investor, when bond yields were at 7% and RBI had moved, I thought personally, and I'm admitting I got it wrong, I thought that the best of the bond rally is behind us. Then comes the LTRO, then comes the global liquidity reboot. So to assume that bond markets and bond yields will harden from here, I think would be too early. With the admission that I got it wrong, I want to hear your views now.
Yeah, so right now, this is the question that everyone is asking, that while the global central banks are cutting rates intermittently in order to address the demand side concern, what if the coronavirus issue is contained? Will there be a sharp pullback in or normalization of the bond yields? And to our view is that perhaps the bar for hiking rate further or normalizing is pretty high at this point of time. As I mentioned, given the fact that the global economic growth continues to remain tepid and patchy, and it's remaining below the policy makers' expectations, and I think the coronavirus related issue is also going to result in a further decline in prospects of economic growth in the first half. So from that perspective, I think the central bankers, particularly the Reserve Bank of India, is likely to come out with policy measures which will address the issue of the economic growth going forward. And from that perspective, I think we expect the RBI to come out with both conventional and non-conventional measures that will aid the economic growth, and that in turn will address the tax collection and revenue measures, revenue collection measures that the government is desperately looking to spend money on productive assets. So yes, I think from a central bank's perspective, the paramount objective is to bring the economic growth back online rather than focusing on inflation at this point of time. And from that perspective, we do expect the RBI to announce a rate cut by between at least 25 basis points on or before the next policy, which is due on April 3rd, and also to consider further increase in LTRO operations, and at the same time looking to balance the demand for vocal borrower to reduce rates and the silent saver in terms of balancing the deposit rates.
All right, gentlemen, appreciate your time. Thank you for joining us.